So you sent waves yesterday talking about granolas. Now, this is not the breakfast bar. This is basically how you identify companies that create value in Europe. What are they?
Well, thank you and good morning to you and to everyone. I think that one of the things we were trying to emphasize with this idea is that a lot of people focus on the US, and the US equity market has outperformed very strongly, of course, over the last decade. And one of the main reasons for that is the success of technology companies. And technology companies have become very dominant in the index, around 25%. And the top 5 companies make up about 20% of that index. But while you don't have as big a concentration of technology, of course, in Europe, you're still seeing a concentration of leadership, which is reflecting companies that have strong growth, strong balance sheets, relatively predictable cash flows. And the granola mnemonic really is just reflective of the particular 10, 11 companies which dominate the European index. These companies were 10% of the market a decade ago. They're now a quarter of the market. And it reflects also the way in which European markets are also changing leadership. 20 years ago, all of the 10 top companies were oil companies and telecoms. There was one bank. Now there are no telecom companies, oil companies, or banks in the top 10. And even though the technology sector is relatively small in Europe, it's now bigger than the oil sector and about the same size as the bank sector. So what we're really trying to do here is identify companies that have strong balance sheets, relatively predictable cash flows, and can strategically grow over the medium to long term in an environment of still relatively weak growth.
Peter, you talk about relatively weak growth. What if we see, a decade of disaster where a lot of these companies also had to cut prices? Is it, I guess, because it's relative value, they'd still hold stronger than the rest of the market?
Yeah, no, I think that's a very good point. Obviously, this is a bit of a relative story. In the end, equities are making a claim on future growth, and the most important thing that drives revenues is economic activity. And right now we're in an environment where economic activity is contracting at the fastest rate since the 1930s. Hopefully that won't last and it will be relatively short-lived. But we should also bear in mind that one of the legacies of this downturn is higher debt, both higher debt in the corporate sector, but also most particularly among governments. And that higher debt is a form of borrowing from the future to pay for growth today. And that generally means that growth is likely to be low, and with it, interest rates. So on a relative basis, given that kind of prospect, companies that can grow relatively predictably, even in a modest way, and have strong balance sheets and perhaps can pay dividends, those are ones that could actually become even more expensive and prosper in what is still a very difficult environment.